NVIDIA's stock has been on an absolute tear, but lately it's kind of hit a wall. So, what's really going on here? Today, we're going to crack open a deep dive technical analysis to figure out exactly what the data is telling us about its next big move. And that really brings us to the big question, doesn't it? After that massive run up, NVIDIA has gone quiet. So, is this just the calm before the next leg up, or is it a warning sign of trouble brewing? Well, that's exactly what this analysis aims to find out. So here's our game plan. We're going to start with the final verdict right up front. No waiting around for that. Then we'll unpack how the analyst got there, looking at the big picture trend versus the moment, decoding some deeper signals, and then mapping out the potential paths forward before we get to the final showdown, bull versus bear. All right, let's dive right in. First up, the main conclusion. We're not going to make you wait till the end for this one. Let's get straight to the bottom line. And there it is. The verdict is healthy consolidation. In other words, the analysis is saying, hey, don't panic. This looks like the stock is just taking a well-deserved breather inside a much larger, ongoing bull market. Let's put that in even simpler terms. Think about a marathon runner. They don't sprint for 26 miles straight, right? They find a pace, maybe they slow down for a bit to catch their breath, and conserve energy for the rest of the race. That's pretty much what this analysis is suggesting NVIDIA's stock is doing right now. So you might be wondering, how can a stock be taking a pause and still be in a powerful bull market? Well, to get that, we need to zoom out and look at the big picture versus what's happening day to day. And this is where you can really see those two different stories playing out. On the left, you've got the long-term view, a clear bull market, trading way above its long-term average. But on the right, when you put it under a microscope, the short-term picture is basically flat. That right there is the definition of consolidation, a powerful trend taking a little break. And this chart, it really puts some hard numbers on that idea. I mean, look at that huge gap between the long-term average way down at 154 and the current price up at 180. That's your bull market strength. But then look how tight the short-term average and the current price are. They're practically hugging each other. That's the pause, shown clear as day in the numbers. And this word, consolidation, is really the key to this whole analysis. It's just the technical term for this phase of sideways movement. You can think of it as the market just being, well, undecided. Buyers and sellers are in a temporary stalemate, just waiting to see who makes the next big move. Okay, so if the price is just moving sideways, how in the world do we know which way it's going to break, up or down? Well, for that, we need to pop the hood and look at some of the deeper technical signals for clues. Now, this is fascinating. This dashboard is giving us a really mixed picture. You've got the RSI, which measures momentum, sitting right in the middle, totally neutral. Then the stock RSI is kind of hinting that things might be a little overbought. And at the same time, the MACD is still in what they call correction mode. You know, the main takeaway here isn't any one of these signals. It's the fact that they're all disagreeing with each other. It's the technical signature of a market that is genuinely undecided. But, and this is a big but, amidst all of that indecision, the analysis found one really important clue, and it has to do with volume. We're seeing something called positive accumulation. All that means is that on days when the price dips a little, more people are quietly buying the stock than selling it. They're seeing these little drops as an opportunity. And check out this number, because it backs that idea up completely. A volume ratio under 1 means the recent drop in price happened on low volume. There was no panic selling, no rush for the exits. This lack of heavy selling pressure is a huge vote of confidence for the healthy breather theory. So, with all this data in hand, how do we start to map out where the price might actually go from here? This next part is all about the key price levels to watch and what the models are projecting for the future. Okay, so get this. According to one model, which basically just draws the most statistically likely path for the stock, the current price is actually trading almost 4% below where it should be. This suggests that if the stock just snaps back to its normal trend, there's some immediate upside. It's kind of on sale right now, statistically speaking. So where is that trend line actually pointing? The model projects a destination price of almost $190. That's the target. That's where the model says the stock wants to go if it can just get back on track. But to get there, it has to win a couple of key battles. Think of 184.41 as the ceiling. The price needs to punch through that to move higher. And maybe even more important is 180.66. That's the floor. As long as the price stays above that floor, the whole positive outlook stays in play. And this all brings us to the final section, the two very clear scenarios that could play out from here, all based on those key levels we just talked about. It's the bull versus the bear.
It honestly boils down to this simple fork in the road. The stock's next move isn't really a mystery, it's a choice. And that choice is going to be made when it either breaks through the ceiling or falls through the floor.
So let's be crystal clear on what to watch for. If you're feeling bullish, you're watching for a clean, decisive break above 184.41. That's the green light that says the pause is over. If you're feeling more bearish, you are laser focused on that 180.66 floor. A break below that would be a major red flag that something more serious is going on. And each of those paths has a likely destination. The bullish path is targeting that $190 level we saw earlier, but the bearish path, if that floor breaks, the price would likely fall to test its next major support level, which the analysis puts down around $176.
So if we had to boil this entire analysis down to one single sentence, this would be it. The data suggests this little dip is a potential buying opportunity, but, and this is a huge but, it is completely conditional on the stock holding that support floor around $180. That is the number to watch.
And finally, the analysis puts a number on this whole setup. It calculates a risk/reward ratio of 1.36. What that means is, for every $1 of risk you might take if the floor breaks, there's a potential reward of $1.36 if it hits the upside target. And in this game, anything over 1 is generally considered a pretty favorable setup. And that's where we'll leave it. This analysis has laid out the data, the signals, and the very clear fork in the road ahead. It's identified what looks like an opportunity, but one that hinges on a very specific price level holding up. So the only question left is the one that only you can answer. Based on all this, is the timing right for you?